Hello, everybody. Ed Yardeni here, wearing my Delaware dad's hat. We went to my daughter's graduation from University of Delaware on Saturday, and we had a lovely time. The weather was great. All the graduates were baking in the sun, but we were sitting in the shade. But it was a really nice ceremony, and we're very proud of our daughter Laura, who managed to get herself a nice job as well in a hospital chain here in Long Island, doing marketing and development. So very happy with all that. Hope that I'm sure some of you might be in the same situation where the past week or so you or ahead you're going to be going to graduations, and again all the best to you and your kids. The subject that I want to focus on today is the subject of Monday's morning briefing, and that's shock absorbers. I've been writing about these shock absorbers for quite some time. I just didn't come up with the idea that this is really that these factors that have reduced the chances of a recession have been of a shock absorbing nature. But that's really been the case. A lot of economists kind of sticking to their macroeconomic models, I think, forgot to include in their models the impact of the pandemic. The pandemic was a huge shock to all of our lives, to our domestic and global economy, and there's been lots of shock waves since then. So first we had the shock of the pandemic and the lockdowns and restrictions and all the crazy things that happened back then. And now that it seems to be more or less over, maybe it's still an issue in China, but certainly not an issue here. Nobody was wearing a mask at graduation time, and there was 5,000 kids graduating, and I guess at least 10,000, if not 15,000 people in the stadium watching the graduation, and everybody was on top of each other without any masks whatsoever. But there have been shock waves in the labor market, for example, in the financial markets, in terms of policy. And of course, one of the shock waves, which is ongoing, is this inflation problem that is one of the legacies of the original shock. So clearly, these shock waves have been an issue, and the biggest issue has been inflation. And in turn, the other big issue related to that has been the Fed raising interest rates. And I think the number one reason that there's still a lot of people out there who think we're still heading towards a recession is because of the tightening of monetary policy. And now that the Fed has gotten us up to 5.25%, which is a level that they were aiming to get to. They viewed that as restrictive in previous summaries of economic projections that they issued. Let me take a little. And sometimes I talk too fast. The issue of the Fed is that it seems to me that they've gotten to where they wanted to get to in their SEP Summer of Economic Projections. They were saying that they wanted to get to 5.25% before the end of the year. Well, they're there, and they've said they want to get to a restrictive level so that they can keep it there. Now, if they just keep going up and up and up, and the restrictive level turns out to cause a recession, then instead of being allowed to keep the Fed funds rate at a restrictive level, they'll have to lower it. So I don't think they want to play that game. And so I think they're going to pause here at the June meeting. And I think it may be the last rate hike, if I'm right, that inflation will continue to moderate, growth will remain moderate, and that they will see that they're heading in the right direction. Now, clearly, the PCED was a setback. I think it was up like 4.4% on a year-over-year basis, up from 4.2%. But rent inflation is coming down. Consumer durable goods prices remain close to zero. Non-durable goods inflation continues to come down. It's in the services, excluding shelter, that we still have a problem, and in some non-durable goods as well, by the way. So we're certainly not in the clear with regards to the inflation issue, but I think notwithstanding the setback, we're going to continue to see inflation moderate. So we'll all be staring at the next CPI for May. And I think that'll continue to show enough moderation that the Fed may very well conclude that rather than taking a risk of exacerbating the banking crisis, I mean, right now everybody's very calm about it. We were calm about it. We didn't think it was going to morph into an economy-wide credit crunch, but the Fed, I don't think really wants to take that risk. So I think they're going to pause. In terms of the shock absorbers, let's look at some of them in the charts. So I'm going to go to the charts now. And one of you asked me to make the charts a little bigger, and so I think I've accommodated you. Hopefully that'll do the trick. I don't know why oh, there it is. So you don't have to stare at my face here. I moved that little video to the right side. But look, as I said, the Fed has come a long way, 500 basis points in raising the Fed funds rate to well above what it's done before. It's the worst tightening, more significant tightening since Paul Volcker, and we know that that led to significant recessions. I think the Fed really does want to bring inflation down without causing a recession, and I think they're on the right course. I hope they don't screw it up. Here, we know that not only have we had the Fed raising interest rates, but we've had quantitative tightening, and that's been another source of tightening. And I've argued that that's 50 to 100 basis points equivalent of a Fed funds rate. I've also argued that the banking crisis is probably 50 to 100 basis points in terms of Fed tightening. The Fed has long said, Powell has long recognized that monetary policy has a long and variable lag effect on the economy. And certainly we know that this banking crisis has tightened up lending standards according to the SLOOS, which is the Senior Loan Officer Opinion Survey. So we know that things were getting tight in the fourth quarter, and they continue to get tight in the first quarter. And that works with a lag. We know that, I think we know that commercial real estate loans are going to be especially tight, and that industry is kind of the next one to go into a recession. I think it's already in a recession. But one of the legacies of the pandemic, a positive shock effect for the economy, was liquidity. And you can see that the federal deficit expanded dramatically, mostly because of checks sent by the government to consumers and to businesses. So that was a tremendous amount of helicopter money. What made that helicopter money is that the Federal Reserve pumped in the money, the monetary base, provided lots of liquidity, kept interest rates low, so interest rates didn't soar with this increase in the deficit. Meanwhile, we are seeing that when you look at the outlays, the outlays were boosted dramatically by all of these checks as a result of the pandemic. Then the outlays started to moderate as the pandemic eased, and we no longer had these rescue programs, these stimulus programs. But now you can see that spending is starting to increase again, and we know that there are a lot of government programs aimed at providing incentives for onshoring, particularly of semiconductor companies. And we also know that companies have an incentive themselves to onshore, given the heating up of the Cold War with China and the proxy war that's going on in the Ukraine between Russia and the West. So put that all together, and there's still lots of spending, notwithstanding the debt deal, there's still lots of spending coming through as a result of government programs to provide stimulus, not only for onshoring, but also for infrastructure. So here's M2, and I know the pessimists have been focusing on M2 declining. We've been focusing on M2 relative to the pre-pandemic uptrend line, and if you just extrapolate this, you still see that there's M2 is about $500 billion above that upward trend line. So we think we're just kind of normalizing, taking some of that monetary stimulus and seeing it going back to a much the pre-pandemic normal trend. Deposits, these are total deposits. This chart, in this chart, the red line is weekly data that we have. M2 now is only published monthly, not weekly, but we can track it pretty closely with the data that is provided for commercial banks for all deposits. When you look at just demand deposits, it's still extraordinary increase. So here's all this helicopter money being poured into the economy by fiscal and monetary policy, and there's still a lot of it left. I mean, I don't know what trend line we take here. If we take this trend line, we're probably talking about $1 to $2 trillion in excess demand deposits relative to that trend line. And you can see that also when you take demand deposits in M2 as a percent of M2, and it's the highest it's been here since the mid-1970s. So not only do we have a lot of liquidity, but liquidity itself has never been more liquid when you look at demand deposits as a fraction of M2 than it was a few decades ago. Meanwhile, the Fed has been saying that they want to lower they want to keep the monetary policy restrictive because their goal is to increase the unemployment rate to take some of the steam out of wage inflation and also to reduce the demand for goods, thereby reducing the inflation rate for price inflation. As you can see here, the unemployment rate, notwithstanding their goal, remains historically extremely low. When you look at the adult unemployment, 3.2%. So this is 3.4%, this is 3.2%. And the teenage unemployment rate is also down dramatically at 9.2%. So the consumer still has liquidity, the consumer still has jobs. And here's the jobs situation. You can see both the labor force has expanded record high as the job market has improved. Household employment record high. It actually seems to be increasing at a faster pace here in recent months. And payroll employment remains in an upward trend, also at a record high. When we look at the employment numbers, we find that there's some remarkable shock absorbers there as well. You would think that in a recession or an imminent recession, you'd see some weakness in durable goods manufacturing. Well, auto production never really got to boom times following the pandemic. It got to about 14, or let's say auto sales, they got to about 14 million units in sales at an annual rate. And here they are basically at the same level. People still have money, they still want to buy cars. There's a lot of pent-up demand for cars and trucks. And so we really haven't seen a recessionary downside in durable goods employment, which is what we've seen in the past. Construction employment is really the impressive one. It's all-time record high, even though we know that single-family housing construction is in a recession, but the multifamily is holding up very well. We know that. And there's lots of other construction for onshoring related activities, as well as for infrastructure that's just starting in many ways. So this, again, is a shock absorber. The labor market's not acting recessionary. It's finding jobs for people. Here's another one, transportation and warehousing. I guess this is the Amazon effect. For quite some time here, we had the trend in transportation and warehousing was flattish up to here. And then the Amazon started building more and more warehouses. So there was more and more warehouse employment. And of course, to get the goods to the warehouses and then to get them from the warehouses to the customer, there's been more transportation employment, more truck drivers. And so since the pandemic, we've had a tremendous increase, well above trend, and this in this area of employment. Payroll employment, retail, wholesale. Retail has been sort of weakish. It's still it's back to where it was pre-pandemic, but it hasn't gone up since then. So that's looking on the weak side. But we know that consumers have pivoted from goods to services. So this is nothing new, and no big revelation, and no reason to worry that this implies that we're going to have a recession. Wholesale all-time record high for that series. Professional business services, again, all-time record high, and it does tend to be cyclical. So a lot of the areas of cyclical employment in the past just aren't doing it. Now, one of the factors we've been discussing before with you is the baby boomers, one of my favorite subjects, because I am a baby boomer, and Peter Lynch, I learned from Peter Lynch that what you want to do when you invest is look at your own life and ask yourself whether other people are going through the same kind of financial conditions, same sort of spending needs related to household formation, related to having children, related to sending children to college, and so on. And what really strikes me here is that the baby boomers are now hold $73.1 trillion of net worth. Net worth. So this is assets minus liabilities. And so this is 52% of the net worth of the other generations, from the silent to the Gen X that are catching up, and millennials. I suppose when they take us baby boomers out in a box and we're leaving the money we haven't spent post-pandemic on ourselves for traveling, for going to restaurants, on healthcare, there's going to be a big windfall for the Gen X population. So I wouldn't be surprised if the Gen X are anticipating that, and therefore may not be saving as much. But anyway, you add it up, there's a tremendous amount of wealth. And some of that wealth is pension benefits. The retired baby boomers are collecting pension benefits. The retired baby boomers are collecting Social Security, and they're being forced to distribute 401k. How do I know this? Because I know it personally. It's what's happening to me. When you look at other sources of income besides wages and salaries for the consumer, they're all at record highs. I mean, it's extraordinary how flush with cash money is just pouring into the consumer's pockets. Interest income, well, we are all looking at how higher interest rates have pushed up the deficit, because net interest costs of the debt has increased. But where's that money going? And it's going to people who own government securities and other kind of instruments. So net interest income for the consumer has increased rather dramatically to $1.8 trillion. It's actually had a little downtick. No, that's never mind. It's an all-time record high. Dividend income, all-time record high, $1.7 trillion. Some of that is subchapter S payments. Instead of profits, they show up as dividends. So that's there. And then there's proprietors' income, $1.9 trillion. And then rental income is $0.9 trillion. So I think the consumer is getting a lot of money from a lot of different sources, and the demographics are certainly suggest that things will continue to remain strong. And that's the shock absorber of the baby boom demographics, and the fact that it's just a richer country where people are making more and they have more wealth, and that wealth generating interest income and dividends. We should really factor that into our macro models and not just focus on wages and salaries, which are doing well, by the way. Another shock absorber here is onshoring. And you can see that while commercial, non-residential construction of commercial may be starting to top here, you can see that manufacturing is off to the races. So that's an important development. Transportation is looking like it might get stronger. Healthcare, again, my daughter got a job coming out of University of Delaware at a hospital company, a hospital organization here in Long Island. And she'll be working on marketing and donors. And so hospitals are spending a lot of time raising money. For what purpose? Well, to build more buildings for all these baby boomers that are going to want more and more healthcare. Also, we never know when pandemics might hit, or we may need more healthcare systems. But we certainly got crushed during the pandemic, and so there's hospitals are clearly aiming to expand. Meanwhile, public construction, which is all this infrastructure spending, we can keep track of that as well. And construction put in place the monthly survey. You can see sewage and waste disposal all-time record high, and these are kind of serious numbers. Highways and streets, 110, 120 billion, all-time record high. Education, that's sort of we'll see how that goes, but I don't think that's that's not one of my stories for why as a shock absorber, but certainly spending on highway, streets, sewage, and waste, and the money being there to make that all happen is an important story. Water supply is an important issue in a lot of communities. Transportation, healthcare. Again, this is public healthcare, and to the extent that the government just keeps getting more involved in the healthcare system, that spending may continue to go up. Meanwhile, real wages, average hourly earnings divided by the consumption deflator has been on a upward trend of 1.2%. So real wages have been growing, contrary to lots of arguments made by progressives that most people have suffered declines in their standard of living. If the standard of living is purchasing power through real wages, then that's been an upward trend, and it's stagnated during the pandemic, but I think it's starting to crawl up here at that 1.2% rate. So if we continue to generate jobs, which I think we will, maybe at a slower pace, real wages continue to go up, and then you've got all these other sources of income, I think the consumer is in good shape to continue to power the economy ahead. Maybe not in a boom phase, but not in but certainly something that's consistent with the economy growing at a slower pace, even a soft landing. Soft landing is economic growth. It doesn't mean that we slowly come down to no growth. It means that we slowly come down to 1 to 2% growth, which is where we are now, basically. Productivity is a big part of our story for the roaring 2020s, which I think is making a nice comeback with the AI revolution, making people realize that a lot of these technologies are going to be working together to increase productivity. We have a labor shortage, and so there's a tremendous incentive to use technology to increase productivity. I think all companies are technology companies now. If they're not using technology to increase their productivity, they're going to fall behind, go out of business. So we were seeing a productivity improvement here. So I think we've had these productivity booms here and here, growth booms back here. I think we're going to see another productivity growth boom going over the rest of the decade to 3 to 4%. I know that sounds crazy, but that's kind of where productivity growth booms have been in the past. And we were starting along that path, I think, with the prior to the pandemic, and then the numbers got all screwed up, and then we had all these quits and troubles finding people, and I think productivity suffered. But I think that's about to turn. This excess savings is another one of the shock absorbers that we've had for a while. Now the pessimists are saying, yeah, but we're going to run out of that, and that's when the recession happens. And my response to that is not this. That ain't necessarily so, because disposable personal income, real disposable personal income, which fell during the pandemic and post-pandemic period, and was offset by all these government payments. Now we're starting to see that real disposable income. You know, in other words, we can ride the bicycle without the training wheels. Another shock absorber has been the banks. The banks just got a shock with the banking crisis. And yet, despite that, there's now talk that maybe it's all over and the Fed can, as a result, proceed with more rate hikes. But at least from a recession standpoint, a credit crunch standpoint, we're not seeing that happen. But the Fed has to recognize that if they get too cocky about it and continue to push rates higher, they're going to continue to create disintermediation pressure for the banks, especially the small banks, regional banks, and they're going to force them to pay a lot more for the rates, and that could be troublesome. Meanwhile, the way to watch the credit cycle unfold here is to watch the weekly data that the banks are, that the Fed provides for the banks. Consumer loans, all-time record high. Residential real estate, I don't get this series, all-time record high. Then we may be starting to see a peak in C&I loans and commercial real estate loans. I think commercial real estate's for sure the peak in C&I loans will simply be that the unintended inventory surge that occurred late last year is starting to ease off. And so there's less need for working capital, for less need to borrow money in order to finance inventories. So I think that's it on the charts. Let's go to the questions here. Okay, so I've got two of them, so I've got room for a few more, though I did kind of overrun my soliloquy here, monologue. So John, the Fed is worried about inflation psychology returning and becoming entrenched. What do you think about this concern? Yeah, I mean, the Fed has always viewed inflationary expectations as a very important variable in determining monetary policy. But I guess it depends. There's a lot of inflation expectations measures. The one I like is the Federal Reserve Bank of New York's survey, and that suggests that inflationary expectations are moderating. I guess the University of Michigan's Consumer Confidence Survey showed a slight increase, but on balance, I don't think there's a case to be made for raising interest rates further because of inflationary expectations. Willem, there will be some fiscal tightening as a result of the debt ceiling compromise. Is this enough to increase the risk of a recession? I don't think so, Willem. I think that there's just so much, we're talking about really a few $1 trillion in the realm of infrastructure spending and, the so-called Inflation Reduction Act and the CHIPS Act. I think the measures that the Biden administration already has passed is locking in a lot more spending on and a lot more government spending than this debt compromise is going to eliminate. Kyle, do you see a catalyst for broadening market breadth? Can your upside target of 48, 45 be achieved without more stocks participating? Yeah, I've been when I get interviewed in the press, I've been using 4,600 just to leave myself a little bit of cushion here. But that 48, 45 is based on just an analysis of what the range in the PE might be looking ahead here relative to our earnings expectations, which are obviously more upbeat than just about anybody else in order to get these kind of numbers. But there has been a big issue with the broadening of the market. Instead of broadening, is narrowed pretty dramatically. We've seen the equal weighted S&P 500 drop sharply relative to the market weighted S&P 500 ever since the banking crisis hit, which makes sense because bank stocks got whacked, energy stocks got whacked because of concerns that the banking crisis would cause a recession. And energy has been sort of weak for other reasons as well. There's lots of supply relative to demand. China's recovery from the lockdowns hasn't been as strong as people had anticipated. But the bears are saying that because the market has narrowed so much, that's a clear sign that we're just in a rally in a bear market rather than the beginning of a bull market, that in a bull market, you get a broadening in the market. And they're absolutely right about that. But it was broadening until the banking crisis. It could broaden again as people get more comfortable with the notion that the economy is hanging in there, and as they discount 2024 increasingly. So I'm in the camp that believes that this too shall pass, that the market will broaden, and that it's not all going to be led by the mega cap 8 stocks. And as we know, since October 12th, you would think that from the arguments that I'm hearing from the bears is that if it wasn't for the mega cap 8, the market would be down. And the implication is that they're the only ones that are up. But the reality is there have been plenty of industries in the S&P 500 that have performed extremely well with double-digit increases since October 12th, and they don't include any of the mega cap 8 stocks. So I think it's a little bit misleading to say that take out the mega cap 8 and the market would have been down. And they always select a period which confirms that. So that's kind of my view on it. Writing about it actually for tomorrow, kind of making a list of why this is turning out, increasingly turning out to be another one of those much hated bull markets. So I'm kind of discussing all the points that the bears are making, and then trying to give you some balance by looking at what they might be missing. So with that, let me thank you for tuning in again. Let's do this again next week, and I wish you a really good week.